In this video, we're going to go through and look at how to trade divergences. Now, the first thing I need to make you aware of is that you're going to want to watch this video at least twice, because there's no way you're going to absorb everything that I'm going to go through in the next 15-20 minutes or so. So this is a really in-depth instructional video for how to identify different types of divergence, how to trade different types of divergence, and how to do it on different indicators as well. Now, my name's Andrew Hewardine. I've been trading financial markets for more than a decade, and on this channel we cover absolutely anything and everything trading related. So if you've got a question on trading or you're just looking for answers, have a look around the channel. There's tons more videos with loads more content that's really useful for you, whether you're a beginning or a struggling trader. But right now, let's take a look at how to trade divergences. Okay, so here we are looking at the Euro USD on a daily chart. Now, I've got a blank chart there, it's daily candles and nothing else. Now, divergence, you're going to need to use some kind of an oscillator. So you could use a MACD, an RSI, a stochastic, a percentile. There's loads of different oscillators that you could choose to use, an ultimate oscillator and so on. Now, if we go to oscillators, you'll see there's a selection of different oscillators through here. We've got stochastic and RSI there, which have been used most frequently. We've also got CCI, we've got MACD. So there's a whole different range of oscillators that you could choose to use. Now, one of the most popular is the RSI, the Relative Strength Index, which personally I really don't like, especially for beginners. Let me just put this on the chart so you can see what it looks like. We'll go with a 7-period RSI. And what you'll see with RSI is there's lots and lots of turning points. It's very jagged, it's not very smooth. And one of the things that when you're first starting out as a beginner trader, or if you're just struggling to succeed, you don't want complexity. And you also don't want loads and loads of discretion. And that's the issue with the RSI. There's so many different little turning points on here that could be short-term highs, could be short-term lows, that it's basically guesswork. And that's another word for discretion, guessing. Because that's all someone is doing when they're using discretionary trading, is they're doing what they think it's going to do next. Okay, and discretion is the enemy of the retail trader, because the chances of you being profitable as a discretionary trader is pretty much zero. All right, so the whole idea is to be as systematic as possible with your trading approach. And when you've got all these different turning points on an RSI, it makes it very difficult to be systematic. Now, if we put something else on that's similar to the RSI, the stochastic on here now, similar kind of time period, an 8-period stochastic versus a 7-period RSI, you'll see how much smoother the stochastic is, because it's a smooth, a filtered oscillator, whereas the RSI is not. And you'll see through here all these different jagged turning points, whereas the stochastic, for the most part, is pretty smooth all the way through there. And again, similarly, as we go through these different jagged turning points around here and turnover, the stochastic is far smoother than that. And again, lots more jagged turning points down here on the RSI. The stochastic is far smoother. So I'd highly encourage you to use the stochastic or even the MACD over the RSI, because especially when you're first starting out, it's going to be difficult to spot these signals. And if you're using an RSI, you're going to start to see them everywhere, and it's going to overwhelm you a little bit. So let's just get rid of the RSI straight away, and let's work with the stochastic. Now, what I'm going to show you now are the reversal and continuation divergences, which are the two different types of divergence. You can use them on a variety of different oscillators. We're going to focus first of all on reversal divergence. Now, reversal divergence, for the most part, finds turning points in markets. Okay, and for a buy signal, if you have a lower low in the price, but a higher low on the stochastic, is telling you that it's a reversal divergence to the upside. Okay, so first of all, lower low in price, higher low in stochastic, they're doing something different. It's a divergence there. All right, now with divergence, with this higher low, what's actually going on behind the scenes there is we have this big strong move down, we have this pullback, and this next move down as well. And what the stochastic's doing is it's, in very simple terms, measuring the strength of those moves. So we have this big, strong move down through here, which then turns around and gives us a low point here, pulls back up again, rolls over, gives us a high point, similarly here on the stochastic, and then we go back down again. Now, what the stochastic is actually measuring, again in simple terms, is the percentage change in the range of price. So when it turns around here, and it's got a higher low compared to the previous one, it's saying, look, this second move down isn't as strong as you think it is. All right, there were a lot of sellers on the way down through here, but there's not as many sellers in this movement down. As a result, it's less likely to continue to the downside. It's basically telling you this movement down is weaker than the movement down previously. Okay, and it's saying when it turns over down here, when this blue line, the %K line, when that rolls over, it's telling you, hey, heads up, we're done, we're probably going to go up. Now, of course, there's no way that you knew it was going to go from the bottom down here all the way up to here. It's silly to even try and attempt that. That's just pure guesswork and sheer dumb luck. There's no way that you're going to trade it from the absolute bottom to the absolute top. But the important thing is that the divergence tells you you have a lower low, you have a higher low. This is a reversal divergence. It's a buy signal to the upside. Now, when does this actually occur? Well, let's actually mark this with a vertical line so that you can see. So at this point we've got, let's just zoom right in so you can see it clearly. We've got the blue line is still pointing down. Okay, we don't know what's going to happen next. As we go forwards a candle, the blue line is still pointing down. So at this point, we don't know, we have no idea it's going to turn around yet. At the end of that bearish candle, we've actually not broken the low yet, to be fair. We're actually still going down. And then as we go over to this next one here, you'll see where this big, bright pink vertical line is. The blue line's now turned up. Now, the really important thing there is if we look at this, and let's just get rid of that pink line to clear things up, we have a lower low. So this price has moved down lower than the previous low. The stochastic has not moved down lower than the previous low, and the stochastic has now turned up. And that's essentially telling you right now in the short term, we've got a short-term change in market movement, and it's likely to go to the upside. Now, we aren't going to be trading these for 10-to-1 reward to risk trades, but even if we just simplify it and keep it really, really, really simple, it's just 1-to-1 reward to risk, then your risk here, your target is at the same distance, you're hitting target inside the very next candle, which is lovely. Okay, so reversal divergence for a buy signal, we have a lower low on price and a higher low on stochastic. Now, reversal divergence for a sell signal is the polar opposite. We flip it upside down. The highs need to get higher in price, which we obviously have through here. And at the same time on the stochastic, the highs need to be going down. All right, so we can see we have a lower high on the stochastic, but a higher high in price. Now, if we really mark this on and show exactly when this turns over, we're still pointing up here. We have broken the high. At this point, you are thinking we're waiting for that blue line there to flick over. Next candle is still pointing up. We've not got a reason to sell yet. Next candle, the great big pin bar that I've just covered up. Blue line's flicked over here. That's the %K line. The first line's turned over. We have a lower high. We have a higher high. We have a reversal divergence. Now, the way that you would trade that, you'd be looking to place a short order. See if I can draw a straight line. Underneath the low of this candle. Now, what happens there straight away, you can see that the next candle, price does not go down. So on my charts here, the blue candles are bullish and the white ones are bearish. But we don't have price move down. So we have the blue line still pointing down. We have a second entry opportunity. And again, the blue line still pointing down, but we've not been triggered into the trade. We want to sell at this level. This candle does not go underneath there. You've not been triggered into the position. Entry level underneath the next one. We're looking to get short. Blue line still pointing down. Divergence is still in place. That's our entry. And of course, you can tell moving across just a little bit there that we get the move that we need. We're not looking for 10 to 1s. We're not even looking for 3 to 1s. Just keeping it nice and simple. Looking for a 1 to 1 there. You get it. Okay. So just kind of summarizing these reversal divergences. If you want to buy, you've got to look at the lows. If you want to sell, you've got to look at the highs. That's really all it comes down to with divergences. Whether that's a stochastic, an RSI, an RVI, a percent R, whatever it happens to be, if you've got a difference in the lows, it's a buy signal. If you've got a difference in the highs, it's a sell signal. Okay, now that same theory carries us across into continuation divergence as well. And there's actually a great example right here on the chart now that I'm going to show you of continuation divergence. Okay, so I just cleared up the chart and got rid of all those previous lines that were everywhere. And remember, we're looking at the lows if we want to buy, and we're looking at the highs if we want to sell. Now, continuation divergences, sometimes referred to as hidden divergences, they are trend continuation trades. They can occur at different times, but 90% of the time, continuation divergences are going to be in a trend. Higher low in price, lower low in stochastic, we have a signal. Remember from before, if you want to buy, or if you're looking at buy signals, you need to look at the lows. We're looking at the lows. There's a difference between the lows in price, and there's a difference between the lows on the stochastic. And you can see, look, this turning point up here on the stochastic does not perfectly match up here. It's, you can see within 3 candles it's there. All right, that's the turning point. Similarly down here, we don't know exactly when it's going to turn. We have to wait for that to actually flick up. This blue candle, still pointing down, no good. On this white pin bar, it's still pointing down. You don't know it's going to turn yet. It's only on this blue candle now that the %K, the blue line of the stochastic, has flicked up, and it's as of this candle that you generate your buy signal. Okay, I'll just hover the cursor so you can see. It's flicked up down here. We're looking at the lows to buy. We actually have a confirmed close of candle, confirmed higher low, and a confirmed lower low. So at that point, you're going to be buying above here. Okay, and you can see there, if you're going for a 1-to-1 reward to risk, no matter where your stop loss was, it's comfortably gone that short distance. Okay, so I've gone through there and shown you a continuation divergence to the upside. All right, and again, we're always looking at the lows to buy. Now we're going to go and look at a continuation divergence for a sell. So if you remember, if we want to sell, we have to look at the highs to sell. So if we're looking at continuation divergence to the downside here, we have a lower high in price, but a higher high in stochastic. That is a difference or a disagreement between what the price is doing and between what the stochastic or the oscillator is doing. As a result, it's telling you, hey, look, something's up here. It's likely to move to the downside. Remember, a difference in the lows means buy, and a difference in the highs means it's a sell signal. Now, you actually generate the sell signal on this one here. Okay, and the reason being, vertical line, you can see on that bearish candle here as it rolls over, we're still pointing up. Okay, we have a lower high in price, we have a higher high in stochastic at that point, but we haven't turned over yet. We still haven't turned over on this small little candle at the top there. It's only the close of this candle that we get the real sentiment shift to the downside, and that's where you're going to be selling. Underneath the low of this candle. And from there you can tell pretty obviously, doesn't really matter where your stop loss was there, you got the comfortable 1-to-1. So let's just kind of zoom out a little bit and put all of these on one screen so that you can see them. I'll just get rid of the entry levels and just focus on the different types of divergence for you. But the most important thing to take away from this video is that for divergences of any kind, you're always looking at the lows in order to buy. Again, over here, you're always looking at the lows to buy. And if you want to sell, or if you're looking at generating sell signals, you need to be looking at the highs. And you can see here, higher high, lower high. And you can see over here, lower high, and you can see over here, higher high. So here you can see we've got the lower lows, higher lows. A difference in the lows generate a buy signal. And again, looking at the lows, a higher low, lower low generates a buy signal. And for the short side of things, we've got ourselves the higher high, which eventually generates a signal here. And the lower high, a difference in the highs between the oscillator and the price generates a short. And similarly over here, a lower high, but a higher high, there's your short signal. Now remember, you've got to wait for that line, that first line, the %K, the blue one, to actually flick in the direction that you are looking to trade. Okay, so you can't sit there and go, oh, it's still pointing in the other direction. You've got to actually wait for it to turn over. That gives you the confirmation. So hopefully in this video you found it useful, you've learned about divergences. I'd highly encourage you at this point to go through and look at the other videos on the channel, because we go through a lot of different concepts and a lot of detail that really help you with your trading. If you haven't already, make sure that you go ahead and click the subscribe button now, click the little notification bell, and you're going to be able to subscribe to all the future releases and extra content we put out on a regular basis. Other than that, as always, stay safe in the markets, and I'll see you in one of my other videos.